A lot of the crypto services have been poorly engineered. Like they had defective economics, defective ethics, and defective engineering. For example, like if I took $1 million of Bitcoin, I loaned it to you, and you took it and put it into some DeFi protocol backed by Terra Luna. Right? You bought UST. Okay, that's a defective yield approach, right? And it's defective because you're generating some air token that you're printing, and you're paying the 20% yield with air token printing. Okay, that's economically not sound. That's ethically not sound because probably it wasn't disclosed. They never disclosed the full extent of the assets, right? And it's engineering not sound because the natural frequency of the network was so high that in the event that the price moves down for a couple of days, the entire network goes unstable, shakes itself apart, and collapses. Right? So we could talk about any of those for hours and hours. But the point is, that's a bad idea. On the other hand, you could probably come up with a responsible way to generate yield. I'll give you another way. If I took $1 million of Bitcoin and I had an account with the Chicago Mercantile Exchange, and the Chicago Mercantile Exchange lets me trade futures. If the futures are actually in backwardation, where there's a time, just in the past few weeks, there's a time where you could sell $1 million of Bitcoin and you could buy it back at a 4% discount because the futures price was 4% lower than the current price. You have to wait 6 weeks to buy it back. Okay, does that happen? Yeah, sometimes it works the other direction, right? Where you could buy the Bitcoin, or you could sell the Bitcoin in the future and buy it in the present, right? And then there's a different direction. In that case, you could generate a yield. You wouldn't be taking a directional position on the Bitcoin. You would be taking counterparty risk against the Chicago Mercantile Exchange. Okay, so there's always a risk, right? But what is the risk, right? That would be actually, that would generate yield off the volatility of the Bitcoin. And how much yield would you get? Well, the truth is you don't know, right? If you're honest, you would say, if you want to trust the Chicago Mercantile Exchange, which is not unreasonable, it's got trillions of dollars trading on it. It's like all the derivatives of the Western world or in the United States are trading on the CME or the LSE. It's not unreasonable, but you might not trust it. But let's say you did. If you want to take that risk, you might generate 1 or 2% yield. You might generate 0% yield in a year. You might generate 4% yield in a year. But you put your Bitcoin with me, and then when I see an opportunity, to go long or short to capture that inefficiency in the futures market, I will do that, and then I will charge you 10% of what I generate, and the other 90% will come back to you. And you have to trust two parties. You have to trust the CME, the exchange you're trading on, and then you have to trust maybe the prime broker or the person executing that strategy. Okay, and the SEC would say, well, you have to then publish, who's the company, what's your balance sheet, what's your background, do you have any criminal convictions, have you ever been found guilty of cheating people, and that way the people that would invest with you would see that you're licensed, and they would decide whether they trust you, and if they trust you, maybe they can generate a sporadic 1-2% yield or 3% yield and still hold their Bitcoin. You see the two extremes? Like, one is doing some batshit crazy thing with an offshore random entrepreneur that may or may not be trustworthy, that's probably going to blow up. The other is taking an informed risk in order to generate a yield. I do think that there are ways that you can generate yield using the capital over time. I think that the state of the crypto banking market or the industry today is such that all of the players in the business, BlockFi, Voyager, 3 Arrows, Genesis, FTX, they were all taking, Celsius, they were taking ridiculous, insane risks. Putting your money in, an air token, putting your money in a DeFi protocol, just outright gambling it, right? any kind of, all the crypto stakings are just ridiculous, insane risk because you're betting on an air token that has no theoretical substance. So most people have suffered or lost money chasing that yield. It's the reason that MicroStrategy never loaned out our Bitcoin to anybody for any yield, even though people propositioned us right and left, all of the usual suspects that you can imagine propositioned us. But the view was, well, I can't trust you. You're not a publicly traded company with a transparent balance sheet. Look, if JP Morgan had come to me and said, we will give you 4% yield on your Bitcoin, and we will back it with the balance sheet of JP Morgan, and we're FDIC insured, would I have taken the yield on my free Bitcoin? Maybe. Right? It depends on the other strings attached, but why not? Right? I mean, so there is a circumstance under which if the bank that's propositioning you is well capitalized enough, and if the contract looks to be solid, maybe you would. Maybe you wouldn't. Maybe JP Morgan would say, look, we can gamble your Bitcoin on a deribit offshore exchange or something, and if we lose it, then we lose it. But we get 20% of the gains while we're gambling it. I wouldn't have done that deal even with them, right? If it was a no recourse engagement. So right now the industry is not quite mature enough, but theoretically, right, it is possible to construct a responsible yield generating strategy if you have a responsible, well-run company, institution that, people get wrapped around the axle on regulated, like regulated is a bad word in the crypto world or the Bitcoin world, but replace regulated with transparent. Like if the person that approaches you says, I'm going to publish my balance sheets and they'll be audited by PricewaterhouseCoopers and you can read them every month, and I'm going to sign the Sarbanes-Oxley statement and agree to be held criminally liable if I lie to you. And, right, I've got a track record of 30 years, and I've got a board of directors, and here's who they are, and this is their background. If they were transparent with you, you would be more likely to do business with them. It doesn't mean there's no risk. You can get ripped off by a publicly traded company. You can lose money on a publicly traded company. But if you consider all the counterparties in the world, the most creditworthy counterparty, right, the ones that are most transparent, that offer the least counterparty risk, are United States-based publicly traded companies, because they have the U.S. has the highest degree of civil and criminal liability for any malfeasance, and they also have the highest degree of disclosure requirements. If I got off the phone with you and my CFO called me and said, hey, guess what? Something bad just happened, or something good just happened. If something bad happened and we lost, 10,000 Bitcoin, or if something good happened and all of a sudden someone gave us 10,000 Bitcoin and it was deemed like material to our shareholders, there's a clock ticking and we have a certain number of hours, 4 business days sometimes is the max, before we have to put in an 8K and we have to tell everybody in the world. And what's drummed into your head if you run a publicly traded company is at 9:30 a.m. on Monday morning, people are going to sell your stock. And if it turns out your company's worth more because of something that happened over the weekend and they're selling it, they're going to feel like they got ripped off, you see, because they sold too cheap. And on the other hand, if something bad happened that makes the company worth less over the weekend and they're buying your stock, right, then those people are going to feel like they got ripped off, right? So when you think about it like that, and that's the way a public company thinks, and that's the way a regulated entity also thinks. It's like every time someone deposits money in my bank, right, they're trusting me. So if I have material information about the status of the bank, or I'm just monkeying around with the back-end control systems, I'm putting my depositors' funds at risk, right? That's a problem.